Good morning. Please take your seats. We're about to get started. Thank you everyone for coming this morning. My name is Sebastian Burke. I'm the Director of Corporate Programs at the Chicago Council on Global Affairs. We're delighted to welcome President Loretta Mester this morning to our platform to share her views on the economic growth, monetary policy, and the Federal Reserve. I would also like to thank our partners for this event, the CFA Society of Chicago. Please know that we are on the record and live streaming. Feel free to use social media, but please remember to silence your phones. Today we will take questions from the room and from online. The link is displayed on screen, and for those watching, please type chi.cnf.io directly into your browser and select today's program. You can ask a question and also vote on a question. We have several exciting events coming up at the Council, including on May 15th, a panel on the future of the EU, and on May 16th, two programs, one on Africa's elephant crisis and a panel on Turkey at Crossroads. We have many other exciting events, so please check our website for the full listing. The Council is a membership organization. If you're a member, thank you very much for your support. If you are not, please consider joining to support our work. For nearly a century, the Council has provided an independent, nonpartisan platform for a variety of different voices to promote deeper global understanding and U.S. engagement in the world. Views expressed by individuals we host are their own and do not represent institutional positions or views of the Council. I will return to moderate the Q&A, but before we begin, please allow me to briefly introduce our speaker. Loretta Mester is President and CEO of the Federal Reserve Bank of Cleveland since 2014. She is also an adjunct professor of finance at the Wharton School of the University of Pennsylvania and a fellow at the Wharton Financial Institution Center. She joined the Federal Reserve Bank of Philadelphia in 1985 and served as economist, senior vice president, and executive vice president and director of research. President Mester is also managing editor at the International Journal of Central Banking and co-editor of the Journal of Financial Services Research. So please join me in welcoming President Loretta Mester.
So thank you very much. Thanks for being here, and good morning. I really thank the Chicago Council on Global Affairs for this opportunity to speak about the economy and monetary policy, and I was really very pleased to get the invitation from Michael Moskow. We've known each other for quite a long time. I've known him since he was sitting at the FOMC table as president of the Chicago Fed, and I was a research director at the Philly Fed. And I always really respected Michael because he personified what we call the collegial atmosphere in the Federal Reserve. He was able to explain his own thinking about issues. He was then able to listen to what other people thought around the table, and it is a very good discussion that we have at FOMC meetings. And then he was able to persuade others about the appropriate path, and oftentimes it was your path that you started out with, but nonetheless he listened to the other people. Michael's last FOMC meeting was August 16th, 2007, and that was the second unscheduled conference call that month. And the FOMC was discussing the profound deterioration in credit market conditions that was happening. Of course, we all know what happened to the economy after that. And so, I've been looking at this. It's common knowledge that Michael stepped down of being president of the Chicago Fed because he had reached the official term limit. But now I'm wondering whether the timing might have had something to do with your keen sense of forecasting about what was going to happen in the future. Now, everyone in this room knows that economic forecasting is both science and art. And today I'm going to give you my views about the outlook for the economy and on monetary policy. But of course, as I always say at every speech I give, these are my own views. They're not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So the economic expansion turns 8 years old next month, and it got off to a slow start, but also from a very weak place. But now the expansion is one of the longest on record. While the quarterly pattern has had its share of ups and downs, output growth has maintained a moderate pace of a bit more than 2% on average over the expansion. Now, the sustainability of the expansion through various economic shocks is a testament to the U.S. economy's resiliency. While some of the recent readings on real activity have been soft, it's normal to see variability in the monthly and even in the quarterly data. In my view, the underlying fundamentals supporting continued expansion remain sound. These fundamentals include accommodative monetary policy and financial conditions, improved household balance sheets, and strength in the labor market that has led to increases in personal income. In addition, although geopolitical risks remain, global economic conditions have improved. Supported by accommodative monetary policy, the recovery in Europe has gained traction, with unemployment rates down and inflation moving up. And the slowdown in the Chinese economy has been more orderly and moderate than what some had feared early last year. Now, while there are upside and downside risks around my forecast, my modal outlook is that over the next year, the U.S. economy will expand at a pace at or slightly above its longer run trend, which I estimate to be about 2%. And the unemployment rate will move further below its longer run level, which I estimate to be about 5%. With appropriate adjustments in monetary policy, I believe that conditions are in place for a sustained return over the next year or so to our symmetric goal of 2% inflation. So now let me put this outlook into context. Despite the strong fundamentals, GDP growth in the first quarter was weak. At this point, I'm not taking much of a signal about future growth from that reading. There's reasons to think that it was a transitory slowdown. For one thing, we've seen a pattern over the past several years of weak growth in the first quarter, followed by stronger growth in subsequent quarters. So even though the data are adjusted for seasonal effects, there appears to be some residual seasonality in the GDP data. The unseasonably warm weather early in the year appears to have weighed on growth, shifting spending from one quarter to another. For example, after growing strongly in the fourth quarter of last year, consumer spending, which makes up about 2/3 of U.S. output, decelerated in the first quarter, in part because the warm weather led to lower spending on utilities. So it's usually a good idea to average through some of these ups and downs when trying to detect the underlying trend. Readings on consumer sentiment and confidence remain high, but more important for spending, personal incomes are growing. So the softness in the first quarter hasn't changed my median run outlook, and I expect a rebound in consumer spending over the rest of the year. The housing sector continues to gradually improve. Despite a rise in mortgage rates, demand for housing is increasing, and in some places, supply has not kept pace with demand. The month supply of existing homes in the market has fallen to under 4 months, its lowest level since early 2005. Our business contacts report that in some cases, it's been difficult to find construction workers to build new supply. The mismatch between supply and demand is putting upward pressure on home prices, which are rising at about a 6% pace on average nationally. Now, it shouldn't really be too surprising that the housing recovery has been a moderate one. The housing boom and crash are not something that anyone wants to repeat. It took some time for household balance sheets and the labor market to recover to a point where households were confident enough to take on mortgage debt again. Borrowers are being careful not to take on more debt than they can handle, and lenders are extending credit, but to those with good credit quality. Multifamily housing activity has picked up more than single-family housing. Going forward, the mix between multifamily and single-family housing may differ from what it's been in the past, as both younger people and empty nesters are drawn to urban environments, and some prefer to rent rather than to buy. Overall, I expect activity in this sector to continue to expand at a sustainable pace. Business activity and investment are starting to strengthen after being quite subdued last year and through much of the expansion. The sizable drop in oil prices from over $100 per barrel in mid-2014 to around $30 in early 2016 led to a sharp pullback in drilling and mining and suppliers to the sector. The 20% appreciation of the dollar from mid-2014 to the end of 2015 hurt manufacturers and other firms dependent on exports. But since then, conditions supporting business spending have improved. Oil prices began to firm in early 2016 and have been roughly stable near $50 per barrel since then. And the dollar has appreciated only modestly on net over the past year. In addition, the firming in global economic growth has increased demand for U.S. exports. Now, U.S. business sentiment is at a very, very high level, but it is not translated into a surge in activity. Nonetheless, we're starting to see a pickup in business spending driven by the improvement in underlying economic conditions. So this gives me some confidence in positive momentum, even if there is some downward adjustment in expectations going forward. Mining activity has increased. The number of active oil drilling rigs remains well below the level seen before the oil price drop, but has roughly doubled over the past year. National and regional manufacturing surveys suggest an improvement in activity and capital spending plans, even if overall sentiment has been tempered. Even though motor vehicle production softened in March, manufacturing production was higher in the first quarter compared to the fourth quarter and compared to a year ago. This is particularly good news for the Cleveland Fed and the Chicago Fed districts, which have a higher share of employment in manufacturing compared to the nation. Both regions felt the brunt of the cyclical pullback in manufacturing, as well as the longer-run shift from manufacturing to services. Contacts in the Cleveland Fed district tell us that even if some of the proposals for tax reform, health insurance, infrastructure spending, and regulatory changes are delayed, they expect the business environment to remain positive and that this will translate into further increases in business spending and hiring. Now, I would welcome a pickup in business investment in plant equipment and research and development, because investment is an important factor influencing underlying productivity growth. Structural productivity growth, how effectively the economy combines its labor and capital inputs to create output, is a key determinant of an economy's longer-run growth rate, the standard of living of its people, and wage growth. And productivity growth depends on factors like investment in human and physical capital and R&D that yields innovative products and processes. Over the past 5 years, labor productivity, measured by output per hour worked in the non-farm business sector, has grown at an annual rate of only about 0.5%. Over the entire expansion, it's averaged 1%. This is a step down from the 2.25% to 2.5% pace seen over the prior two expansions. Now, some of the slowdown in productivity growth likely reflects the difficulty in measuring productivity in the service sector, including healthcare, intellectual property, and information technology, which is becoming a larger share of the U.S. economy. Some of the slowdown is likely cyclical, reflecting the persistent effects of the Great Recession. Indeed, it did take a long time for investment in physical and human capital, key determinants of productivity growth, to emerge during this expansion. As the expansion continues and investment expands, it's reasonable to assume that the cyclical impediments will abate and we'll see somewhat stronger productivity growth. This assumption underlies my expectation that longer-run growth will be 2%. But in addition to the measurement and cyclical issues, structural factors are likely weighing on productivity growth as well. Monetary policy cannot address these structural issues, but other government policies, if they're well-designed and focused on spurring productive investments in human and physical capital, R&D, and innovation, would be helpful and could, with sufficient time, lead to a somewhat higher, longer-run growth rate. Another important determinant of long-run growth is growth in the labor force. U.S. demographic factors, including the aging of the population and a lower birth rate, especially if coupled with restrictions on immigration, suggest that labor force growth will be considerably slower than it's been in recent decades. This means long-run growth will likely remain lower than the 3 to 3.5% rate seen over the 1980s and 1990s. Indeed, the downward trend in labor force participation rate is one of the factors we considered when assessing the conditions of the labor market. So let me discuss labor market developments now. In 2016, the economy added over 2.2 million jobs, about 187,000 jobs per month on average. Over the first 4 months of this year, firms sustained that pace with a monthly average gain of 185,000 jobs. Now, this is a slower pace than in the two expansions in the 1980s and 1990s. But it's important to remember that because labor force participation is lower, trend employment growth is also lower. Indeed, estimates of trend employment growth range from around 75,000 to 120,000 per month, depending on the precise assumptions one makes about labor force participation. So the recent employment growth numbers are well above trend. As the economy has added jobs, the unemployment rate has moved down. It stood at 4.4% in April, less than half its peak of 10% in late 2009, and at the lowest reading achieved in the previous expansion. Although payroll job growth is likely to slow a bit from its current pace given the progress that's already been made in the labor market, I expect the pace will be sufficient to keep the unemployment rate below my estimate of its longer run rate of 5% over the next 2 years. Other gauges of the underutilization of labor have also improved significantly. For example, the broader U6 measure of unemployment, which includes the number of part-time workers who would rather work full-time, and the number of people who have been discouraged from looking for a job, has fallen to its lowest level since late 2007. In addition, the labor force participation rate has been essentially stable for the past 3 years. So relative to the downward trend, the stability we've seen in participation is actually another sign of strength in the labor market. For much of the expansion, wage growth has been subdued compared to what we've experienced in other expansions. Partly this reflects slow productivity growth. Still, we have seen a gradual acceleration in wages over time as labor market conditions have strengthened. For some time, we've heard from our labor and business contacts across a broad set of industries that firms are having trouble finding qualified workers, both in high-skill occupations and in lower-skill jobs. More and more of these firms are responding by raising wages and offering other benefits to attract and retain workers. Contacts in the Cleveland Fed District expect wage increases to average about 3% this year, with significantly higher increases expected for highly skilled workers. These anecdotal reports are showing through to the wage data, where measures such as the Employment Cost Index and average hourly earnings have accelerated from earlier in the recovery. This is a welcome state of affairs. I'm a big opera fan, so I like to look to opera to give insight. So one of the characters in Beethoven's opera Fidelio sings, "If you haven't money by you, happiness is hard to find. But when it jingles around your pockets, fate is at your mercy." So on balance, we've seen a sustained cyclical recovery in labor markets since the Great Recession. There are some longer-run structural issues that the country must tackle, such as making sure people have access to and the training and development needed for jobs in the modern economy. But from the standpoint of the cyclical conditions that monetary policy can address, I believe we've achieved the maximum employment part of the Fed's monetary policy mandate. Now, the other part of the Fed's dual mandate is price stability. Consistent with meeting this part of the mandate, over the longer run, the FOMC has set a goal of 2% inflation as measured by the year-over-year change in the price index for personal consumption expenditures, that is PCE inflation. Most people understand why high inflation is a problem. It erodes the purchasing power of your money. But inflation that's too low is also a problem. It can lead consumers and businesses to delay purchases, thereby slowing the economy, and it increases debt burdens. For some time, inflation has been running below the Fed's 2% goal, but over the past 2 years, inflation has been moving up. In March, we saw a decline in readings on consumer price inflation, but I'm taking little signal about the future path of inflation from those numbers. They partly reflected some one-off changes, such as a decline in prices for cell phone service plans, and they came after strong readings in January and February. Measured year-over-year, headline PCE inflation stood at 1.8% in March, up from under 1% a year ago. Now, in determining where inflation is relative to our goal, we need to look through transitory movements in the numbers, both those below and those above our goal, and focus on where inflation is headed and where it will be maintained on a sustained basis. The inflation rate over the longer run is primarily determined by monetary policy, but we know that we can't keep actual inflation at 2% at each point in time. Inevitably, shocks hit the economy, and the inflation numbers move, sometimes below our target and sometimes above. Still, we want to take actions to keep inflation from running either persistently below or persistently above 2%. In other words, our goal is symmetric. It's not a ceiling, and we aim to keep inflation at 2% on a sustained basis. With appropriate adjustments in monetary policy, I believe the conditions are in place for a sustained return over the next year or so to our symmetric goal of 2% inflation. These conditions include the firming in inflation that we've seen over time, reasonably stable inflation expectations, continued strength in the labor market, and growth expected to be at or slightly above trend. Now, appropriate adjustments in monetary policy are those that will sustain the expansion so that our longer run goals of price stability and maximum employment are met and maintained. In my view, we've met the maximum employment part of the mandate, and inflation is running near our 2% goal. So although we live in a high-frequency world, we cannot overreact to transitory movements in incoming data. Our policymaker has to focus on what changes in economic and financial conditions imply for the median-run outlook and risks around the outlook. If economic conditions evolve as anticipated, I believe further removal of accommodation via increases in the federal funds rate will be needed. In March, the FOMC raised the target range for the Fed funds rate by 1/4 percentage point to 3/4 to 1%. And last week, the FOMC decided to maintain this range. Both decisions are consistent with the gradual upward path of interest rates that the committee has indicated for some time is likely to be appropriate to achieve and maintain our objectives should the economy evolve as anticipated. This upward policy path will help prolong the expansion, not curtail it. It will help avoid a buildup of risk to macroeconomic stability that could arise if the economy is allowed to overheat, and risk to financial stability should overly low interest rates encourage investors to take on excessively risky investments in a search for yield. It will put monetary policy in a better position to address whichever risks, whether to the upside or downside, are ultimately realized. Now, given my outlook, I don't believe that removing accommodation calls for an increase in the Fed funds rate at each meeting. But I do anticipate more than the one increase per year seen in the past 2 years. In addition, I think it's important for the FOMC to remain very vigilant against falling behind as we continue to make progress on our goals, especially given the low level of interest rates and the large size of our balance sheet. We know that monetary policy affects the economy with long and variable lags, so policy actions have to be taken before our policy goals are fully met. If we delay too long in taking the next normalization step, and then find ourselves in a situation where the labor market becomes unsustainably tight, price pressures become excessive, and we have to move rates up steeply, we could risk a recession. This is a bad outcome that disproportionately harms the more vulnerable parts of our society. Now, in addition to removing accommodation by raising interest rates, we also have to consider the Fed's balance sheet. To address the financial crisis and Great Recession, the FOMC undertook several programs to purchase longer maturity assets. These purchases aimed at putting downward pressure on longer-term interest rates once the FOMC's traditional policy tool, the Fed funds rate, had been reduced to effectively zero. As a result of the purchases, the Fed's balance sheet has grown from nearly $900 billion in assets in 2007 to about $4.5 trillion today. And its composition has changed from mainly short-term Treasury securities to mortgage-backed securities and longer maturity Treasuries. Normalizing the stance of policy also means taking steps to normalize the balance sheet, and the FOMC recognized this need from the very start of using non-traditional tools. Currently, the FOMC is continuing to reinvest the proceeds of maturing Treasuries and principal payments from agency debt and mortgage-backed securities, essentially maintaining the balance sheet at its very large size. But as indicated in the minutes of our March meeting, the FOMC is discussing its reinvestment policy, including when and how best to implement a change in reinvestments. Such a change should be done in a way that allows for a gradual and predictable reduction in the Fed's asset holdings, so that over time the balance sheet is reduced to the smallest size needed to implement monetary policy efficiently and effectively. In my view, if economic conditions evolve as I anticipate, I'd be comfortable changing our reinvestment policy this year with clear communication in advance about how we plan to implement the change. My preference is that once we decide on a plan, we stick with it. The Fed funds rate should be our main tool for responding to changes in the outlook during normal times. Because it will take several years to reduce the size of the balance sheet through asset runoff, we can end reinvestments before we have decided on the ultimate size of the balance sheet. This decision is essentially one about our longer-run monetary policy implementation framework. Do we want to operate with scarce banking reserves, the so-called corridor system, or abundant reserves, the so-called floor system? Regardless of which framework is chosen, the Fed's balance sheet will be considerably smaller than it is today. I view the purchase of longer-term assets as a non-traditional tool that should be reserved for non-traditional times when we've lowered our policy rate to near zero, and we need to add more monetary policy accommodation because of a deterioration in economic and financial conditions. Ending reinvestments and beginning the journey toward a smaller balance sheet composed mainly of Treasury securities will be a welcome acknowledgement that the economy has entered normal times and policy is transitioning back to normal too. So in concluding, it's important to remind everyone there are risks around the economic outlook. And because of that, policy is not preset. Policy needs to remain systematic in how it reacts to incoming information relative to the outlook, but not be dogmatic should the outlook indeed materially change. In March, the FOMC began providing confidence bands around its economic and policy path projections. These are very good reminders to both the public and to policymakers that there's always a lot of uncertainty around economic forecasts. There's uncertainty because the economy is constantly being buffeted by shocks, data are revised over time, and it isn't clear which model will best predict the future path of the economy. Today, I view the risks to the real economy and to inflation over the median run, the time horizon relevant for monetary policy, as roughly balanced and see a gradual reduction in monetary policy accommodation as appropriate. I acknowledge that there are geopolitical risks out there, including tensions in North Korea and the Middle East, but these aren't the kinds of risks that preemptive monetary policy action can mitigate. Still, these types of risks need to be recognized when assessing changes in economic and financial conditions. Indeed, some of the recent downward pressure on long-term interest rates likely reflects some flight to quality flows in the face of rising geopolitical tensions rather than a material reevaluation of the modal outlook. In addition, there remains uncertainty about what fiscal and other economic policies might be forthcoming. These include changes to infrastructure spending, regulation, and policies pertaining to taxes, immigration, and trade. When one gauges the effects, both positive and negative, of any forthcoming policy changes on the outlook for growth, employment, and inflation over the short, medium, and longer runs, the devil will be in the details in terms of the size, composition, timing, and financing of such initiatives. My view that it's appropriate to continue on the gradual path of monetary policy normalization is not dependent on fiscal policy, but instead is based on my reading of the resiliency of the U.S. economy's underlying momentum and the progress we have made on reaching our monetary policy goals of maximum employment and price stability. Thank you for your attention, and I'm happy to take some questions.
Thank you, President Mester. If you have a question, please raise your hand, wait for the microphone. My colleagues are in the back with the microphone, and please make sure that your question is a question and not a comment. So we have one question over there in the third row, please.
So what is your assessment of the impact of automation on the economy and on employment?
It's an excellent question. So, there are two underlying trends that have been affecting the U.S. economy for many years. One is trade, globalization, and one is technological change. And the technological change has, they're related because globalization allows for technology to change at a quicker pace. But nonetheless, this has improved the U.S. economy. So technological change is not going to stop. It's improving the overall U.S. economy. But I do think that, and some of the things I mentioned in terms of policies to address sort of the disruption of technology have to be thought about. So, we do have some people that do not have the training necessary to take on jobs in the modern economy, jobs that will be forthcoming because of the technological change. In my district, and I would submit in Chicago, where manufacturing is an important part of what we've done, you've seen a long downward trend in employment in the industry, even though output hasn't necessarily fallen, and that's because of this automation. So the real, I think, trick and the real focus of the U.S. has to be on how do we make sure that the people whose jobs are affected by automation develop the skills necessary to take on the work in the future. And I think that's something that the country has to take into account. From the standpoint of monetary policy, there's nothing that we can do about that with our policy tools, but there are things that the U.S. can do in terms of policies, human capital development, innovation programs, partnerships between business and universities and other training programs that have been effective. There are a number of examples of that. The real question is, how do you scale that up for the kinds of technological advances that we're going to see in the future? So I think that's a very important thing for the country to think through. What are the best policies? We have a number of examples of things that are working, but I do think we need to focus on that because, as you've seen over time, right, this issue of income inequality has grown, partly driven by the fact that we haven't probably paid as much attention to the winners and losers, even though the country as a whole and in aggregate is benefited by technological change. We have this issue about how do you distribute that.
In the middle, please, yes.
Thank you, Loretta, for a very comprehensive view and forecast. I was intrigued by your mention of the broader unemployment rate, because after years of hearing that the core unemployment rate isn't really a good indicator, I don't know much about this broader index, but I was curious as to what actually is the metric for that, like what's the percentage on this broader index?
Right.
And maybe more importantly, do you think Wall Street's trading off that broader index or not? And, just talk about that a little bit more.
Yeah, so the Bureau of Labor Statistics puts out a number of different measures of unemployment. The U3 measure is the headline one that you always see picked up, the 4.4%. And frankly, I think that's a pretty good indicator of, overall conditions in the labor market. But in this cycle in particular, what you saw is if you include people who have gotten discouraged out of the workforce, that they basically have said, I think conditions are so poor out there that I'm not even going to look for a job. They don't get into that headline unemployment rate. And if you think about people who are working, so some people who work part-time want to work part-time, it's good for them. But other people are working part-time because they really want a full-time job, but they can't find full-time work. These broader measures include in steps, a broader group. And so the U6 measure is the one that is the broadest measure. It too has come down. I mean, there's always a gap between the measures. There's always going to be higher U6 than U3. But it too has fallen very sharply over this expansion as it's continued. It hung up there for a while, and so people who were saying, wow, the unemployment rate's coming down quickly, a lot of people started to turn to some of these broader measures. And so there has been some attention paid to that. And the gap was a lot larger early on in the expansion than we had seen in other expansions. And I think that's why it gained some attention. But even if you look at it now, right, the gap is narrowing, and that broader measure is down to the levels that we saw in late 2007. So again, overall conditions in the labor market, even if you go to these other, discouraged workers, marginally attached workers, people who really want to work full-time, they've all improved. There are some people who obviously haven't been able to get back into the labor force. Some of it may be cyclical. I think from the standpoint of the cyclical part of what monetary policy can do, we're at full employment. But these longer run issues about, do people have the skill sets? I continually hear from contacts in my region that it's very difficult to find people with the skill sets they need. And some firms would like to hire more people, they just haven't been able to find them. Well, that's a problem for the country. How do you do that? How do you make sure people have that training? Some of the firms are actually offering their own training. once they get people in the door. Some of them are going to community colleges and setting up programs that they can actually then, have a feeder of people with the skills they need. But I think this is a big issue for us as a country to try to solve. The U6 number is below 10%, so it's fallen, so, yeah.
All the way in the back, please.
Yes, just keeping on the focus on labor, isn't the real issue labor mobility? Maybe that they're jobs, but people don't feel confident to move? The people with the skills perhaps is an overhang of the housing crisis? And my second question is, aren't we due for a recession in terms of the business cycle? And isn't this just the wrong time to start tightening? Do you think the Fed could be getting ahead of itself because this has been an expansion that's been unprecedented? Thank you.
So you're right. I mean, certainly this, in the Great Recession, one of the key drivers was, of course, the crash in the housing market. And so there was this lock-in effect that people, were not, moving because they couldn't, their housing, they couldn't move, they couldn't get a new house, they couldn't relocate. That has seemed to have abated over time. That doesn't seem to be driving now what people are doing. There are people willing to move. There are other studies. There's an interesting study by some economists at the Cleveland Fed on my staff who actually looked into some of the data on mobility. And of course, probably not surprising to people in this room, people who were located near family actually fared better than the people who had gone out and were on their own more. And I think because of the social, the safety net when you're in a location. But they're trying to delve into that. What are the reasons for this? Your basic point that labor mobility is a crucial element is true not only cyclically but also structurally, right? I mean, one of the great things about the U.S. relative to other countries like Europe is that we have in some sense, relatively very flexible labor markets, that people are willing to move and people can move to location and, find a job that matches, their skill sets and that employers want. So that's something that we need to pay attention to as well. We don't want to give that up because it has improved things. My own view is that the economy is ready for us to take back some of the accommodation. I mean, monetary policy, even after the two moves we've made, is still quite accommodative. I don't ascribe to the belief that there's a certain length of time that a recession lasts and then it's done. I mean, if you look at precipitating events for recessions, it's not old age. It's because some external shock hits, new shock hits. It's because policy hasn't been calibrated correctly. It's not really old age. But remember also what deep hole we were in the recession. So if you were just stepping back and saying, and we didn't have a big bounce back, right? It took a long time for the economy to gain traction again. So in some sense, even though we've dated the recession at a particular point, relative to the prior recoveries, right, we were in a very deep recession. So it shouldn't be maybe that surprising that it's been a longer time to get to where we've gotten to. That adds time to the recession too when you're just looking historically, like how long has this one lasted? But again, I don't really subscribe to the view that at some point it's got to end because of timing. It really is going to, if something happens, it's because there's some external event or because policy has been miscalculated or miscalibrated to the economy. And that's why I think it's very important for us. We've made a lot of progress on our two mandated goals. Right, price stability, we're not there yet, but we're getting there, and the data is, showing that we've had this, up path, and I think that'll continue. And on employment, the cyclical part of employment, we're at full employment. By some measures, we're a little beyond that. Very important in that environment that we take some of the accommodation that was important, for the economy up to this point, start taking some of that back, because we want, as the economy normalizes, we want policy to normalize as well. So it's really not aimed at, curtailing an expansion. It's really aimed at calibrating it to where we are on our goals, because we think that's the best way to keep the expansion going.
Over here, second row, please.
Thank you. Could you explain more about confidence bands and how the Fed could do a more effective job at conveying uncertainty in the forecast? Is it such that if the Fed can convey uncertainty and articulate it much more effectively in a counterintuitive way, it would build more confidence in the forecast?
So I've been a proponent of trying to do exactly what you're saying, which is try to give an indication of, what is a typical error band around an economic forecast. As the forecasters in this room know, right, that, if you look at GDP forecast a year out, right, the error bands are plus or minus 1 percentage point. That's a big error band, but most people would say, oh my gosh, if the Fed didn't, hit their forecast within, 0.5%, that somehow they're bad forecasting. Well, no, that's just the nature of the art of the science right now, is that that's kind of how forecasting is. I do think that it's important for people. We work for the public, and it's very important for them to hold us accountable, but it's also important for us to tell them, this is the state of the art. When you do economic forecasting, a number of things that you may not anticipate can happen, and so you should expect some variability around these numbers. Early on, one of the tools the Fed had to use in its policy was forward guidance, right? We had run out of room on the funds rate was basically at zero. We had increased the balance sheet to put downward pressure on interest rates. The other tool we used was so-called forward guidance. We wanted people to know we're committed, we're in on this accommodation. We are committed to it, so that they would feel comfortable that the economy was going to get out of its doldrums and get back to a more normal, pickup in growth, et cetera. And that was, I think, a very productive thing to do. But there's a downside to everything. And the downside perhaps was that people now expect us to be very precise in next month we're doing this, next month, 2 months we're doing this. Well, unfortunately, the economy can evolve, and so you have to always entertain the possibility that things could come out in an unexpected way, and you want your policy to respond to unexpected events appropriately, right? You don't want it to be gyrated around because the stock market's up one day and down another day. You want it always to be filtering your data through your forecast. And if things turn differently than you expected and it affects that medium run forecast, your policy path might have to change, right? And so when the Fed in March, they decided that, we should be conveying some sense of the uncertainty around our forecast so that people aren't misled into thinking like this is set in stone, that this is what's going to happen, because that's just not, the economic science isn't there yet. And I don't think it'll ever be there. We're a social science. There are a lot of things that, interact the economy. And so let's be honest with people. And then, you'll be able to hold us accountable better because you'll know sort of, what we're thinking, what the typical error bands are, and, did you respond appropriately or not? So I'm a big fan of being honest about, what the state is. I do think there are things that we could do to better articulate uncertainty, and it's something that the Fed has been trying to evolve toward over time, try to improve our communications, try to be as forthcoming as we can. We are working for the American public. It's very important that Congress holds us accountable for our policy, and so I think that's an important part of, we want to be transparent. We want people to understand what we're doing, why we're doing it, the rationale for our decisions.
So we'll take a question from online. This is the most voted question. Can you speak about how the Fed has moved from an interest rate target to focusing on financial conditions more broadly?
Okay. So I think there is more understanding of the role since the crash, of course, and the Great Recession, of the important role that financial stability plays in the U.S. economy. And so I think there's more recognition of that. I would submit that financial conditions have always been part of the calculus of figuring out the medium run outlook. I think you always want to, take signals from changes in asset prices, and, including the stock market and other conditions. We obviously, loan rates are very important. So that body of financial conditions have always been part of how we evaluate the economy. But I do think that there's a recognition that financial stability matters for the U.S. economy. And so even within the FOMC, there are quarterly reports on financial stability. If you look at the minutes of the meetings, you'll see that there's discussions of sort of where we think the risks lie. And, there's a broader discussion, I would say, because I've been going to FOMC meetings for many, many years before I was on the FOMC. I think there has been more discussion of financial stability concerns and issues with financial stability, and more appropriate, I'd say, monitoring of financial conditions, both in banking and also recognition of the so-called shadow banking system and the impacts it can have. I think there's more recognition of the effect that movements in the exchange rate can have on the U.S. economy. I think that's something that we discuss more. We've seen that certainly through this cycle. That strong appreciation of the dollar, it impacted both growth, but also the inflation numbers. Remember that it held down inflation, import prices were low. So again, I think there's much more reconnaissance on it. I think it was always part of the calculus, but now I think there's more attention paid to it, and recognition that these kinds of asset price changes, exchange rates, capital flows can affect the U.S. economy.
Yeah, we have in the back, in the middle, yes.
Thank you. You mentioned the balance sheet of the Fed and the assets on it. How would you rate the risk quality of those assets?
Well, I mean, the mortgage-backed securities are agency mortgage-backed securities. And of course, the Treasury securities are U.S. Treasury securities. So I'm not worried about the credit risk of the portfolio. There is there's some interest rate risk, right? Negative remittances are a possibility whenever we hold things, if you mark to market. But from the standpoint of what the Fed, can the Fed operate? Yes, right? So that's not a worry. I think the bigger worry is, we've gotten to a point where we don't need that kind of stimulus anymore, right? Policy is normalizing in terms of both the interest rate is moving up, the economy is on sound footing. And so it's just a natural time for us to shrink the balance sheet. And the remittances that we give, right, we pay interest on reserves, and so you can have a negative remittance over time as we shrink the balance sheet. But that won't impinge on any way about the way the central bank goes about central banking. Maybe that'll be a political risk because it'll look like a negative remittances. But you got to remember that we've been remitting very, very large amounts back to Treasury early on because the balance sheet has been large and interest rates have been low. So I don't think that's an issue in terms of the actual mechanics of how we go about addressing the balance sheet issue. So I think of that as there may be optics involved in it, but that's not a mechanical or any kind of substantive issue for us the way we implement policy. I don't know whether that helps to answer your question. Yeah, okay. That's good enough. If I can sort of answer every question, I'm doing well.
So I actually have a follow-up question on that from online. If the Fed is going to begin to slim its balance sheet this year, when can we expect to see a description of how that will be done?
Well, of course, it's the FOMC makes decisions about when to, talk. My own personal view is that we certainly, and, Chair Yellen has said this, that we want to be, forthcoming when decisions are made, right? We will let the public know what the decisions are, and we want to make sure that people understand how we're going to go about doing it before we actually implement. So I can't give you more precise because decisions come out of the committee and you'll see the decisions when they're made. But it is important that we convey, right, those decisions before we actually undertake an implementation of that policy change.
You're in the middle. Please wait for the microphone.
We all know the Fed's dual mandate of keeping inflation around the target and employment as full as it can be. I could predict a lot of people that there'll be growing political pressure, even if it's a de facto third mandate, as our federal debt grows, even if interest rates stay relatively low historically, that politicians, the public, begins to say, oh my God, the interest on our debt has now become the second, the third, maybe the second, maybe the biggest outlay. How will the Fed deal with the pressure, even if it's not asked to make it an official mandate, but an unofficial de facto mandate when down the road it's predictable as our debt continues to grow that it have another, unofficial mandate, and that political pressure begins to grow, saying, you guys, even if we are, let's say, in a situation where we have low inflation and stable low unemployment, that you guys need to continue QE or launch QE because we're now paying $1 trillion of interest or $500 billion of interest. Does that ever get talked about? Do you have any personal thoughts on that? That could be 5, 10, 15 years down the road, but it's coming.
So this is exactly why it's very important that monetary policy decisions be not influenced by politics and short-run political considerations. This is when people talk about the independence of monetary policy, and the reason that you want to preserve it is precisely because at any point in time, right, you gave a good example of one where you see political pressures building, perhaps. We need to be isolated from that, and it's got to be very clear that you do not want monetary policy to be distracted from, right, what we can do, which is price stability and maximum employment. And, I do have some concern that some of the proposals to change the structure of the Fed and the way we do policy will make us more vulnerable to those kinds of political pressures. And so, I think what we have to do is I always say, like, we got to stick to the knitting. We've got to stick to what our mandated goals are and think about the economy over the long run. In the scenario you gave, of course, that would be, if we think policy is correctly appropriate, we would be basically throwing away our price stability goal by going down a path that you suggest. And so, if we stick to our mandated goals, right, we push back that sort of problem. And we've been under pressure before. During the crisis, of course, there was political pressure on the Fed to buy certain assets. And, we said, no, we can't do that. And if you've read Ben Bernanke's book, he talks a little bit about some of the pressure that he was under during those times. It's very important that that not influence the central bank's policy. Very important that we stay looking at the median run, price stability, and maximum employment. And so, what I always say is, I do think that some of the changes that are being proposed, and partly maybe we haven't articulated it as well as we could, make us in a more vulnerable position of sort of mixing political interest in with the Fed. And the structure of the Fed, I think, protects us from that. This fact that we have the board in Washington and the reserve banks around the country, I think, is very important, because I think that actually brings diverse views from all parts of the country. But then when we get to that FOMC table, we know we're focused on these median run things that we can control, and we don't talk politics. We don't talk about, political considerations. That's very, very important. And as you point out, one of the, you've pointed out one issue about political pressure, but there's always political pressure on the Fed to do things, and we've got to be very much Congress, it's up to you to figure out the long-run sustainability of the budget deficit, and we, right, figure out what we do here with monetary policy.
All the way in the back, next to the aisle, please.
You mentioned the external shocks that precipitate recessions, and with the Great Recession being the housing bubble. Has the Fed started to identify potential areas where that external shock could come from leading up to a next recession?
Yeah. So, that's part and parcel of doing monetary policies. We're always looking out, to sort of evaluate not only what our modal outlook is, but also sort of where the risks are and where they might come from. So, in the U.S. case, one of the things we're treading is, as we were talking, right, how do you calibrate monetary policy? We've been very accommodative for a long time. We, need to, step back from that, right? How do you do that appropriately? My own personal view is that the risks are basically balanced at this point, roughly balanced. So, there are some downside risks, if we go too quickly, say, but there's also some upside risks. As I said in the speech, right, fiscal policy is a bit of an unknown at this point. It's hard to evaluate what will eventually come out and what that will be. But if we do get spending, that would be a short-run boost probably to the economy, and we'll have to think about that. So that's an upside risk. Europe may come back faster than people had thought. That's another potential upside risk. On the downside, there's still some issues in the European banking system. And so that's something we're watching. So, and, these geopolitical risks I mentioned, tensions, right? That's something that you really can't plan for when you're doing monetary policy, but certainly we have to evaluate, keep our eye on developments both in the U.S. economy and abroad. So, there's just a number of things that we look at internationally and locally. But again, I think the economy here is doing quite well. I think the economy in Europe, if you look at their growth statistics and their inflation statistics, are doing much better than they were. China, of course, is having to change their whole economy, structural changes in their economy. That's certainly something that we look out for. You remember early last year, that was a big concern of many economists, but that seems to have gone a bit better than some had feared. And so they've stepped down. Their growth is stepping down, but it looks like it's stepping down in an orderly way. So there's just a number of things that we monitor. But the message that I would like to leave you with is that at this point, it looks like there's upside and downside risks, and they're roughly balanced. And the U.S. economy does seem to be on a good track.
There was another question all the way in the back, if you don't mind.
Thanks. Back to the intersection of policy and politics. The president's recent insight to who he might put into the OCC. I was wondering how you view someone that is very pro-banking would impact the overall economic and financial system, and how that would impact the Federal Reserve's bank regulatory arm if there is a disagreement as to how the two institutions view the implementations.
So I won't talk directly about appointees, but in general, we understand the important role that banking plays in our economy. Certainly community banks, we meet with them, quite a bit. I talk to community bankers all the time. We have banks on our represented on our boards of directors, so we interact very much with them. And we work with our fellow federal regulators to implement banking regulation. So, we each have our own purview of which part of the banking system that we regulate and monitor. So I think whoever gets in there, we'll have a very strong working relationship with them. We'll do the best we can to implement the laws that Congress, asks us to implement in terms of bank regulation. Within the Fed right now, we're taking a number of steps to try to lower the regulatory burden on the community banks that have felt, for some time that some of the regulation that they had to be subject to was really not right size for them. So the Fed is taking a number of steps in recognition of that. And I think, whoever ends up, running the OCC, the SEC, and other federal regulators in the financial space will have good working relationships with.
Okay, one more here. Third row, please.
I wanted to get your thoughts on the trade-off between balance sheet policy and rate policy. So if, later this year the economy improves and it's appropriate to tighten, would the decision, say, not to reinvest proceeds mean maybe we should hold off on rate hikes, or how do you balance the two at an individual meeting?
Yeah. So I'll give you my own personal view. My own personal view is that probably at this point the balance sheet is not having as large an effect as it did early on, right? So you remember when we undertook QE1, right? That was when financial markets were disrupted, we were adding liquidity. That, there wasn't a lot of trading, and arbitrage going on in the financial markets. That's why our intervention there had bigger impacts. Frankly, if we reduce the balance sheet in this predictable, gradual way, I don't see that it's going to have that big of impact on the economy at this point. And so I don't feel a need that we'd have to, do sort of this trade-off. Frankly, we don't know enough about what that trade-off actually would look like. But again, we're doing a slow thing. So we'd have time to react. Suppose I'm wrong. Suppose the balance sheet is having this much bigger impact than I anticipate. Then we'd be able to, react because we'd be reacting because the economy would be reacting to a withdrawal of accommodation, perhaps bigger than I thought it was going to be. What I think is most important is that we, say we have this, whatever we end up doing, we commit to some path, glide path of getting the balance sheet back to more normal territory. And then we set policy using our interest rate tool as our main tool. I'm not saying that we would never buy assets again. Of course, if the economy, something bad happens later on and we find ourselves in a situation where we've reduced the funds rate again and we are in a situation where the economy needs, stimulation at that point, then I think QE's on the table. I think we've shown that it can do some good. I just don't think of it as being a tool that we want to think about as we can either do QE or interest rate policy. I think QE really should be reserved for these non-normal times and use our interest rate policy as the tool for normal times. But again, I don't think that it's having that large an impact that we'd have to do that kind of technical thing where we try to do the trade-off. I just don't think we have the expertise to do it, and I don't think it's necessary to make a decision about doing that at this point.
Thank you. Unfortunately, that's all the time we have this morning, so please join me in welcoming President Mester.
Thank you very much. Thank you.